A total meltdown in repo markets. SOFR spreads are soaring as the Fed loses total control. Yields are spiking, the dollar is surging, and a $2 trillion Treasury basis trade could be unraveling right now as repo chaos and SOFR stress echo 2019's liquidity nightmare. There is tremendous stress in the financial plumbing, and cracks are most certainly widening at a rapid rate. So here we can see we just got the data for Friday with, of course, a record amount. SRF, the standing repo, the Fed's emergency liquidity backstop, got tapped. $50 billion that the financial system needed to borrow on an emergency basis from the Fed on Friday. Well, we just got the cost of capital, the price of an overnight dollar loan in the SOFR market, which again is about $3 trillion per day. And SOFR spreads are completely blowing out. As we could see for Friday, SOFR came in at 4.22. And again, this coincided with the standing repo, the Fed's emergency liquidity backstop, getting tapped for $50 billion on Friday. When you combine the AM and the PM session, well, it was not just end of month sort of thing. We can see again this morning it got tapped another $14.7 billion. And of course, we will wait and see what the afternoon standing repo comes in at. The reason this is important is, again, the Fed does not set an overnight interest rate, one overnight interest rate. They set a corridor or range. That is how they control the most important price of all. In the entire financial system, the most important price is fixed or attempted to be fixed by the Fed, and that is the price of money itself, the price of a dollar, the interest rate of an overnight dollar loan in the SOFR market. Again, about $3 trillion per day financed in the SOFR market. And what we can see is SOFR, the actual market rate, dependent on supply and demand, is notably above the Fed's ceiling. Now, again, remember the way they do this, the reverse repo award rate or interest rate, currently 3.75. That is the Fed saying no matter how overabundant dollars get in the financial system, we will always buy them at 3.75. So they've basically guaranteed that SOFR should theoretically not go lower than that. Then on the other hand, discount window rate is the exact opposite. That's the Fed saying no matter how scarce dollars get, we will always sell them. Right now, that rate is 4. Well, as we can see, SOFR, which is the actual cost of capital, what the free market of, again, supply and demand of cash versus collateral. These are secured overnight loans where one party puts up collateral in the form of U.S. Treasuries and the other puts up cash, and then they exchange at the next day with, of course, a little bit of interest. That is indicating significant shortage of liquidity. In fact, we are now above the Fed ceiling. And again, this is indicating that the Fed is losing control on the most important price of all, which is the price of an overnight dollar loan, the price of a dollar itself. We can see 22 basis points above the ceiling. And again, this is not just end of month sort of stress. We can see this is actually the 5th day in a row where SOFR, the actual free market cost of capital, has been above the discount window rate. So again, the Fed cuts, which if you just look at this, might make it difficult to make sense of everything. But once you take a spread like SOFR minus the reverse repo, which again is the floor here, 3.75. Once you look at a spread, it is abundantly clear that there is liquidity strain and it is turning into a crisis. So 22 basis points. We are not talking about 1 or 2 or 3 basis points. This goes all the way back to March of 2020, and we can see that 22 basis points above the Fed's ceiling, that discount window interest rate. This is only comparable to March of 2020, of course, when the basis trade unwound. And of course, we have been following this and flagging this exact probability or possibility for like 3 months now. And the reason is that we've been watching the SOFR minus reverse repo spread. And again, this is a helpful way of thinking about liquidity tightness, the supply and demand for dollars relative to how many dollars are actually in the system. If there is a shortage of dollars, you are going to get a higher price on those dollars. They are more scarce. And what we can see is going all the way back to July, when we first started flagging this, we have seen SOFR minus the reverse repo just go straight vertical. And of course, this has coincided with a plummet in terms of bank reserves. Now, remember, bank reserves are the base layer of money. They are half of the monetary base, or the M0. They've gone from 3.4 trillion to just 2.8 trillion. And this is due to a number of factors. Heavy Treasury bill issuance by the Treasury to fund these massive deficits is drawing cash out of the system. Remember, if a Treasury auction of $110 billion, someone is getting Treasury bills, securities, and the Treasury Department is getting cash. So it is removing cash from the system. Not only that, but the reverse repo, which was a storage tank of excess dollars that the Fed was incentivizing to kind of sterilize, to keep them with the Fed, to prevent them from going and causing inflation. This shock absorber, it is not notable that it is zero in and of itself. All the reverse repo is saying, being empty, is that there is no longer a buffer. There's no longer a shock absorber when it comes to liquidity strains. Therefore, what we see is an elevation of SOFR spreads coinciding with a plummet in bank reserves. And this is because liquidity is tightening. Now, bank reserves in this chart are inverted. So not only have we transitioned from an abundant liquidity regime where this was positive into one of negative, indicating liquidity scarcity. And again, this line finished the day on Friday at 1.4 billion, but it has dipped negative over the past week or two. Again, indicating a shift from a regime of abundant liquidity into one of scarce liquidity. But if we zoom in on the correlation here between bank reserves inverted and the SOFR spreads, what we can see is a tight correlation, which is that as bank reserves go up and become more abundant, the level of bank reserves goes up, SOFR stress, the reverse repo SOFR spread, comes in, and vice versa. As SOFR spreads blow out, as they have been, indicating liquidity strain, that coincides with a decrease in bank reserves. So again, this is all talking about the same phenomenon, which is liquidity is far too scarce. And again, we are 22 basis points above the discount window rate. This, as I showed in the other chart, never has happened going back to March of 2020 when the basis trade unwound. And of course, here is a more zoomed in look at the past couple weeks or so. We can see this is not a normal 2 or 3 basis points above the discount window rate. This is 22 basis points above the discount window rate. And again, that is indicating the Fed is losing control over the most important price of all, which is the price of an overnight dollar loan. And as you can see, normally they keep control over the SOFR market and that overnight interest rate. You can see it's pretty rare that SOFR goes above the discount window rate, which is here in the dotted line in zero. But we are now 22 basis points above. And again, when March of 2020, it was only 28, 29 basis points. So we are dangerously close to the same exact level that we saw in March of 2020 when the basis trade unwound. Well, what is the basis trade? I did a whole video on it that I will link at the end here, but very simply, it came out. We thought that these were the major foreign holders of our debt. You can see Japan, 1.1 trillion. Cayman Islands was down there at number 4 at about 400 billion. But the Fed came out with a report showing that, oops, the Cayman Islands are actually by far and away the largest foreign holder of U.S. Treasury debt, over $1.8 trillion, an undercount of $1.4 trillion. And the reason the Cayman Islands, a tiny little tax haven with a GDP, an annual GDP of like $7 billion, the reason the Cayman Islands are the largest holder of U.S. Treasury debt, they are engaged in a highly leveraged trade called the basis trade. And again, I explained it in simple English. That'll be linked at the end of this video. But very simply, they are short a bond futures contract and they are long an underlying treasury. And there is a tiny little spread that you can collect. It's about 10 basis points. Well, 10 basis points is nothing. Therefore, you have to lever it up 50 to 1 to 100 to 1. This is a well documented risk. The SEC has written papers on it, the Fed has written papers on it. It is unwound before. And what you would see, of course, in an unwind where you're short the future and long the bond is to close that, you reverse each leg. So you sell the bond and you buy back the futures contract, putting more upward pressure on the future than on the bond. So I asked AI, you can take this for what it's worth, and I gave it a bunch of data. I showed it yields, what the dollar is doing, what SOFR is doing. I gave it all this data and I said, objectively, do you think the basis trade is starting to unwind? And it said yes, potential early indicator. This is one of many reasons. Of course, we can see a bit of a gap here developing where futures are outperforming TLT, which is the actual cash bond. And not only that, but yields are going vertical, as we can see in the 2-year, the 10-year, and the 30-year. This has coincided with earlier in the day, a pretty good dollar strength. We are seeing that starting to reverse. It hit resistance at the key psychological level of 100, so to be expected. But interest rates have been moving vertical. Now, part of this is due to Fed Jerome Powell's hawkishness at the latest FOMC press conference. Of course, we've also seen liquidity sensitive risk on sort of corners like Bitcoin and S&P 500 not have the best performance recently. That is to be expected during a liquidity crisis. And of course, bond yields are going straight up. Well, again, if the basis trade were to unwind, you would see that. And we saw it in early April, and we know what ended up happening. Trump ended up pivoting on the tariffs. The basis trade was unwinding in early April. It also unwound in early March when SOFR became notably elevated above the discount window rate. And the reason that the two are connected is the basis trade is funded in the SOFR market. So that basis trade is constantly being financed on an overnight basis and rolled every single day in the SOFR market. So if the price of financing that trade, the trade could be going fine, right? You could assume that, this chart is doing exactly what it normally does. There is no widening of the basis. You can assume that. But if the cost of funding the trade, again, you're levered 100 to 1. If the cost of funding the trade starts to blow out on you, well, that could, because you're levered 50 to 1, 100 to 1, that could put you under significant stress, cause a forced unwind of your basis trade. Again, selling of the bond, putting upward pressure, sharp upward pressure on interest rates. They are inversely bond yield and bond price, remember. And of course, upward pressure on the futures contract. So it's too early to say it is not a full-blown March 2020, but the fact that SOFR's 22 basis points above the discount window rate, and again, this is not an isolated sort of incident. We've seen the discount window rate be surpassed by SOFR for 5 days in a row now, indicating they are losing control. And not only that, but we see an increasingly frequent usage and an increasingly large usage of the Fed's emergency liquidity backstop, which is the standing repo. So we will wait and see what the afternoon standing repo comes in at and do an update then. But anyways, hopefully that was helpful. Excited